All right, everyone, get ready to rethink how you approach your investments because today on the deep dive, we're crafting your essential investors checklist.
Hmm.
This isn't about chasing the next hot tip, okay? It's about making smarter, safer financial decisions, and it's really rooted in the timeless wisdom of Benjamin Graham.
That's exactly right. Graham's core principles, they really emphasize that a stock isn't just, a ticker symbol flashing on the screen.
Right.
It's an actual ownership interest in a real business.
Okay.
It has an underlying value.
Okay.
So our mission with this deep dive is, well, to equip you with the critical questions, the insights you need to understand what truly matters before you invest your hard-earned money.
So if a stock is fundamentally a business, how should we approach the market itself when we're building out this checklist? What's the sort of foundational mindset we need?
Well, Graham famously viewed the market as like a pendulum.
A pendulum.
Yeah, perpetually swinging. It goes between this unsustainable optimism, making stocks way too expensive,
Huh.
and then it swings to unjustified pessimism, making them ridiculously cheap.
So extremes.
Exactly. And the intelligent investor, the one using a good checklist, is a realist. They use that pessimism to buy, and the optimism to, well, maybe sell.
Buy low, sell high, the classic advice.
But it's more than that. What's fascinating here is Graham's consistent warning against trying to forecast price movements. He basically said it's less reliable than a coin flip.
Right. So prediction is out.
It really is. The goal for your checklist should be protection from overpaying, not trying to predict the next wiggle.
That's a powerful image, the market as a pendulum. But isn't it incredibly hard for people, especially when fear or greed is rampant, to actually be that realistic?
Oh, absolutely. It takes discipline.
How do you build that emotional discipline into a practical checklist?
Well, that's where the discipline really comes in,
Yeah.
and leads us directly to the, let's say, operational side of investing. If understanding Mr. Market's moods is crucial for our mindset, how do these insights translate into the practical day-to-day decisions? Like choosing how to invest specifically, picking a fund.
Okay, so from mindset to method, what's the next big checklist item when choosing how to invest?
Simplicity. That's a huge one. As John Bogle put it so well, the secret of investing is, finally, that there is no secret.
Ha! I like that. No secret.
Yeah. He, like Graham, really championed avoiding complexity. And on your checklist, the most crucial factor, honestly, it's cost.
Cost, right, fees and expenses.
Exactly. You've got hidden transaction costs, plus the visible expense ratios. They can just consume a huge chunk of your returns over time.
It's like compounding but working against you.
Precisely. It's a statistical truth, almost hard to believe sometimes, but year after year, the vast majority of active fund managers, even the supposed gurus, fail to beat a simple, low-cost index fund after you account for their fees.
So paying more doesn't mean getting more.
Often, it means getting less. Over decades, that seemingly small difference in fees can literally eat up half your potential returns. It's like running a marathon with ankle weights. Some equity funds can cut investor returns by 10% or more just from their stated expenses, plus those hidden costs.
Wow. Okay, so simplicity, low costs. That seems pretty clear. But let's be honest, people are still drawn to funds with amazing past performance. That track record feels so compelling.
It does, doesn't it? But here's the thing, and this really needs to be on the checklist. There's basically no evidence, none, that superior past performance predicts future success.
No evidence at all.
Statistically speaking, no reliable predictive power. It's a phenomenon called reversion to the mean.
Reversion to the mean. Explain that a bit.
Think of it like a basketball player on an incredible hot streak. Eventually, their shooting percentage tends to fall back towards their career average, right?
Yeah, makes sense.
Same goes for fund performance. Exceptional periods, they're rarely sustained forever. A fund's risk profile might be stable, but its performance, not so much.
So chasing last year's winner is probably a losing game.
Generally, yes. For the typical investor, wide diversification, which you can easily get through something like a total stock market index fund, is far more sensible than trying to pick a few best ideas or chase hot streaks.
Less exciting, maybe, but more effective.
Much more effective over the long run. I remember one client absolutely convinced he had to pick the next big thing. We talked diversification. He finally went with a total market fund. Years later, told me it was the most boring and most profitable decision he ever made.
That really brings it home. So even with a simple, diversified, low-cost approach, it sounds like we still need to be, well, pretty vigilant.
Definitely.
Are there other red flags, things to scrutinize on our checklist, especially regarding management and the information they give us?
Yes, absolutely. A key checklist item.
Yeah.
Be skeptical of management. Their interests don't always align with yours.
How so?
Well, watch for things like creative accounting that might distort the real earnings picture, or practices like charging marketing expenses back to the shareholders through advisory fees.
Sneaky.
It can be. Always pay careful attention to those proxy statements, the detailed annual reports. Look for any increases in fees, like those 12b-1 fees. They're often just marketing costs paid by you, the shareholder, benefiting management more than helping your returns.
And check how management gets paid, too.
Crucial. Look at their compensation structure. Are they rewarded for short-term stock price bumps, maybe through options, or for genuine long-term value creation? Their incentives really should align with yours as a long-term owner.
Got it. So pulling this all together, what does this mean for you, the investor listening right now, trying to build their own checklist?
It means real investing success. It usually comes from a disciplined, long-term approach. You prioritize understanding the business value, keeping costs incredibly low, diversifying broadly, and maintaining a healthy skepticism. Skepticism towards market hype and towards management promises.
So the biggest risk isn't the market going up and down.
Not really, no. Short-term volatility is normal. The biggest risk is the long-term risk of not putting your money to work wisely, maybe because of high costs or chasing fads, or just making poor choices based on hype instead of facts.
So time is your friend, impulse is your enemy. As you think about your own financial journey, ask yourself, are you truly investing for the long haul with a solid checklist, or are you still kind of caught in that speculative churn reacting to the noise?